Good afternoon, everyone. This is Financial Literacy 101. I'm your host, Ross World. All right, so today we're going to jump right into the best passive investments for your portfolio. We're always talking about investments, and quite frankly, what are passive investing? That's a question that people talk about residual income, passive income, but the question is, what is it? All right, I'm gonna give you the definition. I like to give you guys a definition so you know exactly what we're referring to and what we're talking about. Passive investing is an investment strategy mainly to maximize returns by minimizing buying and selling on the exchanges, on the markets. Okay, so passive investing is an investment strategy to maximize returns by minimizing buying and selling on the market. And we're going to get into, of course, your index. We're going to get into your peer-to-peer lending. We're going to get into your dividend stocks, and of course, real estate. Okay, real estate, because we have to understand that passive investing broadly refers to a buy and hold portfolio strategy for long-term investments, okay, within the trading when it comes to the market. Again, passive investing broadly refers to buy and hold when you have that sort of portfolio strategy where you're not trying to do a lot in the market, right? You're not you're not trying to go in the market and buy and sell like a day trader, or maybe every month you're going there. This is simply for you to buy and hold. And we're going to talk about what I believe are some of the best passive investment strategies for your portfolio for you to sit back and collect some money. Okay, sit back and collect some money. If you're in the chat, let me see you in the chat. Who's in the chat today? But I'll get started and I'll talk about my infamous and my famous index funds. Okay, index funds. We understand that certain index funds are tied to a particular market, like the S&P 500 index, whether you buy it with Fidelity, Charles Schwab, or Vanguard, is tied to the S&P 500 market. That's just an example, okay? We understand that they have low cost management, okay? The management to run those are very low, and the name that they use to run those costs is expense ratios, right? They have very, very expense ratio. What's up, Jay? J Mike got two first names. They have really low expense ratios, right? And they also are passively managed. Anytime someone's talking about passively investing, 100% of the time you're going to hear them talk about index funds. Okay, that's the difference between a actively managed mutual fund versus, because index funds are tiered under mutual funds, but they are operated differently. Index funds are passively managed while mutual funds are actively managed. Actively managed mutual funds, it costs you more in taxes and also broker and commission price versus an index where they actually go out in a research with statistics and analytics according to the metrics. And when they're building that fund, when they're building that index fund, they're going to get the best shares of a stock, or excuse me, the best stocks out there on the market to generate the most wealth for you without changing any of them. We understand that mutual funds, they may change funds every day, every week, every month. Whatever that broker deems to do, he is trying to do for the best interest of the portfolio, which in turn costs you more money in taxes. Every move when it comes to mutual funds costs you, the investor, money on the behalf of your broker, but he is doing his job. But at the same time, he's charging you fees for his services, and also, the government will get their money when it comes to taxes because you're dealing with capital gains, okay? With index funds, you're not moving your money around. You're just passively sitting and letting the money slow grow, which is great because you're not going to pay higher in taxes, okay? Those are your index funds. My favorite. Everyone, if anyone's been a part of this channel for more than a day, you know your boy loves some index funds. All right. Dividend stocks. Dividend stocks. See, the thing I like about dividend stocks, and you have to be careful, is that when a company gets paid, so do you. It's like when the company gets a good payout, you get that money as well. And we're going to get into what they call Dividend Aristocrats. Okay. Dividend Aristocrats are basically companies for the past 20 or 25 years have consistently have raised the amount of dividends they're paying to their investor. Okay, I'm going to give you a quick definition of what a dividend aristocrat is. A dividend aristocrat is a company that not only pays a dividend consistently, but continuously increases the size of its payments to its shareholders. Okay, their payouts to their shareholder. They consistently raise the amount of dividends that they're going to pay out to their investor. So some of you are like, wow, you probably didn't even know that exists, right? Dividend aristocrat, those companies that actually pay you more each year. We have to understand that most dividend aristocrats, they're not looking to raise the value of their stock in the market, right? When I used to invest in Tesla, they were teetering around 200 and 220. Now Tesla is at 330, 340. But last time I checked, I don't think Tesla is paying any dividends, right? Because they know they still have room to grow. A lot of companies who are dividend aristocrats, they teeter within the $50 market. They know they're not going to have a $100 increase within a year like Tesla. This last year, Tesla was like in the 200s, okay? So I'm going to give you a few companies. How about that? I'll give you a few companies that consistently pay their investors, you, the investor, more money every quarter from the past 20 to 25 years, okay? I'm going to butcher some of these names, but I'm going to give you the name, and I'm also going to give you the ticker or the symbol that you can go on Robinhood or Stash or any other investment platform in order for you to invest in them and get some return on your investment, your ROI. All right, Cintas, that's CINTAS, and the ticker is CTAS. Another one, S&P Global, that's S&P Global. The ticker, SPGI. Air Products and Chemicals, that's Air Products and Chemicals. APD is the ticker. Cincinnati Financial, that's CINF. That is the ticker, CINF. Ecolab, that's Ecolab, and the ticker is ECL. Now, according to Forbes for the 2019 list, the best aristocrats, let me see what it says here. Now, it's according to Forbes, but it's also built on expectations for the dividend aristocrats. And we have AbbVie. The ticker is ABBV. Walgreens Boots Alliance. That's Walgreens Boots Alliance. And the ticker is WBA. Another one, AT&T. The ticker T. Caterpillar. The ticker is CAT. And last but not least, Cardinal Health. That's CAH. Okay. And dividends are a good way for you to either reinvest your dividends so they compound, or you can actually cash out of your dividends. So it just depends on where you are in life. You might need that dividend money coming in, especially when you have so many stocks that give out dividends. I know a few people who actually live off their dividends. I mean, like live off their dividends. So that may be a way for you to do that as well. Another passive way of investing is peer-to-peer lending. And this is about 10 years old now. Okay, peer-to-peer lending is about 10 years old. And the two big boys on the market, okay, the two big girls on the market is Prosper and the Lending Club. That's Prosper and the Lending Club. Now, granted, last year I was investing with Prosper and I made a little money. Okay, I made a little money. And you're like, well, what's a peer-to-peer lending? Essentially, you go on one of these platforms and you're looking for loans to invest your money in. Now, depending on how much you put into that loan determines your return. Now, if you have that amount of money, you can actually buy out the whole loan. Now, the real money comes in the risky person who needs that loan with a low credit score. Because banks is not the only way that you can obtain funds to do, buy a car or start a business, buy a boat, whatever it is that you want to use money for, and you want to have a loan. Prosper in the Lending Club is a great way for investors to invest inside loans, buy loans out. So the consumer goes in, the borrower goes in and pay interest on that loan just as they would a bank. Just think about you, right? When you bought your car, you went to the nearest bank or your bank and they ran your credit and they said, okay, sir, you are funded up to $30,000. Or they might have just said, oh, you want to buy that car? You are fully funded by us at this percentage. With Prosper in the Lender Club and other peer-to-peer lending platforms, it's the same way. But you essentially are the bank, right? But they already have the percentages listed on how much they're going to pay out. And the money comes in when you go into a loan that say this is for the risky borrower or the people with the low credit score. Now, high risk, high return, because the percentages pendulum swings from 5% to 12%. Okay. I did a risky investment. The loan was about 10%. I forgot how much I actually put into it, but I know I doubled my money. Okay. I doubled my money. So peer-to-peer lending is a great way for you to do that. And this is key for people who want to get into this, because this was when it came to private investments and bankers, it was only offered for you to put money in for what they call accredited investor, an accredited investor. But a lot of us are non-accredited investors. And I want to break down very quickly what a non-accredited investor is. This information, this definition, this explanation is coming from investopedia.com. Okay, I'm going to try my best to read it. So excuse me if I stumble, but I won't fall. A non-accredited investor is an investor who does not meet the income or net worth requirements set out by the SEC, and that's your Securities Exchange Commission. The concept of a non-accredited investor comes from the various SEC acts and regulations that refer to accredited investors. An accredited investor can be a bank or company, but is mainly used to distinguish individuals who are considered financially knowledgeable enough to look after their own investing activities without SEC protection. The current standard for an individual accredited investor is a net worth of more than $1 million, excluding the value of their primary residence, or an income of more than $200,000 annually, or if you're married, $300,000 annually. A non-accredited investor, therefore, is anyone making less than $200,000 annually or less than $300 annually, including their spouse. That also has a total net worth of less than $1 million when their primary residence is excluded, not included. So now we know that a lot of us are non-accredited investor, but you can still be the bank and buy out loans or buy into loans. You don't have to buy the entire loan. You can actually buy into loans and get a percentage back from your amount. And on these platforms, it will tell you, hey, this is a risky loan, this is a good loan, et cetera, et cetera, et cetera. That's actually a great way to invest. And you're like, man, I don't have a lot of money. It only takes $25. You can invest as little as $25. So believe me, you have the money. Because you know that you was at the club last night. No, I'm kidding. I'm kidding. Well, maybe you was. I'm kidding. You went to happy hour though. I know you did. What's going on, Ashley Hawkins? Anyway, where we at? So we talked about index funds. We talked about dividend stocks. We talked about peer-to-peer lending. Let's talk about real estate. All right, we understand there's a couple of ways to invest in real estate. You have your traditional investing in rental property, where you actually go out and buy rental property. But a lot of people don't want to do that because you don't want to buy rental property and you have to deal with tenants and their issues. Like me, I call all the time like, hey, this is broke. The knob on the little exhaust fan is broke. The toilet won't flush. Like my light bulb went out. Like, this is your apartment. I just live here. You take care of all this stuff. The doors on the pantry don't close. If you want, but that's the traditional way. The other way I tell people about is REITs, okay? REITs, Real Estate Investment Trust. And one of the platforms is Fundrise. And the cool thing about that is that they pay out 90% of their taxable income as dividends to investors. But however, there is a downside, okay? There is a downside because you're getting that money. It could be problematic for you, the investor, because it may put you in a higher tax bracket. Like for me, I always receive those 1099 DIVs because of all the dividends that are coming in to my account. So what I try to do is I try to reinvest them because I don't want them counted as my income. I want to keep it in a market and as it grow. The only time I want to be taxed is initially like a Roth IRA, initially. But I know that eventually you're going to be taxed, but hopefully by then there's some tax benefits where I'm not getting my butt taxed out the yin yang, okay? So you have your traditional way of buying rental property and receiving profit and dividends off of that. You also have your REITs, your real estate investment trust. Then you also have your real estate crowdfunding, where you can invest either in equity or the debt of a property, whether it be commercial or residential. And you know what a commercial property is versus a residential. A commercial property could be something like your Walmart. A residential property is a house or where people live at. Ashley Hawkins says, I have a rental property looking to sell it though. Now, list in the chat, where is your rental property, right? Because here's the thing. I'm not an MLS where you list properties and things of that nature, but it may be someone in the video, in this live session, or who sees this live session later who wants to know where this property is. So you should list that property, Ashley, and as well put your business email, not your personal email, but your business email so people can contact you on you selling that property. They can get all the information. Use this platform for your business gain. I'm not above it. I'm not against it, okay? This is a family. We're all trying to work together. Somebody might be interested in that rental property, right? And give you an offer you can't refuse. Like, you bought the rental property for $50,000, they're offering you $150,000. Okay, so list where the property is located, the state and the city, and also list your business email address so people can contact you. That is my advice to you, Ashley. That way, you just never know who may watch this video or who's in here. They may be eager to buy some rental property. All right, if you don't have any questions, guys, literally, those are my best passive investing for income that I can possibly think of. You have your index funds, you have your dividend stocks, you have your peer-to-peer lending, whether it be with Prosper or the Lending Club, and you have your real estate, whether it be buying out rental property or investing into a REIT. And the one I invest is called Fundrise. They also have another one called Rooftop. And you also have your real estate crowdfunding, whether it be investing inside of the equity of a property, the debt of a property, and whether it be commercial or residential, okay? Or residential. Now, when it comes to dividend stocks, don't forget about those Dividend Aristocrats. those dividend aristocrats, those companies for the past 20 to 25 years have paid out increasingly amount of dividends to their investors every year. This is information that school doesn't teach you. This is information, unless you're a finance major, that college doesn't teach you. Little stuff like, oh, you should invest, but you should invest, especially if you want passive income, into companies that are dividend aristocrats. That way, you know every year your dividends should increase or may increase, because that is why they are dividend aristocrats. D General, good afternoon. D General is asking, is peer-to-peer loaning comes like an app like Stash? Stash is an investment app, not so much for loaning people money. Now, Stash has been adding a lot of accessory investing, right? I don't know the proper term, but they're doing so much out there. They're doing roundup investments like Acorn's doing. I'm trying to figure out if I saw that. I was on there just the other day, and I believe I saw something. But the two ones I'm talking about, D General, is Prosper and the Lending Club. Now, I'm going to go ahead and switch on Stash real quick, because a lot of times Stash has information right when you open up their app. So I'm going to see, because I think I know what you're referring to. But the two ones, no, it wasn't Stash. Stash was referring to Fast Money. It says sign up to get your pay as early as 2 days. Don't do none of that stuff. Like when they try to pay you your paycheck, you're going to dig yourself in a hole, okay? Just make a budget and be good stewards of your finances. But D General, the ones that I've known, the one that I invest in was Prosper, but Prosper and the Lender Club are the two biggest on the market, okay? And I made a little money with Prosper. So those are the peer-to-peer lending. Stash, I will keep that for your investments, for your micro and fractional investments, where you want to buy into ETFs and index funds, or they now have individual stocks. So that's what I would use Stash for. And in Stash, I have a link in the description for that, as well as Robinhood, okay, as well as Robinhood. So hopefully you guys learned some information today about passive income investing. That's passive income investing. And to do a recap of what that is, okay, passive income investing is simply an investment strategy to maximize your returns by minimizing buying and selling on any of the markets. Okay, it is an investment strategy to maximize returns by minimizing buying and selling. What I like to do when I talk about passive investing, I like to just say, yo, I'm just making money chilling, dog. You know what I'm saying? I'm just making money relaxing. Like right now, just made some money. You ain't see it, did you? It went over your head. That is passive investing, where you're doing nothing because you have your money in a buy and hold status and is making money for you. That's one of my slogans. My money makes money. Another one of my slogans, learn money and be inspired, right? Because when you learn money, you get this fuel under you because you want to do so much. You want to go so fast. But the first term fuels the second term. Learn money. Learn money and then be inspired. You can't be inspired then learn money. Well, I guess you could, but I like the learn money portion first. Anyway, all right, I'm glad I could answer your question, D General. I'm going to get out of here, guys. Hopefully you learned something. I didn't want to make it long today. I want to get straight and right to the point. This is Financial Literacy 101. I'm Ross World. My money makes money. Learn money and be inspired. But I tell you, man, you better do some passive investing, because if you don't do it, I'm going to do it. I'm going to make all the money you should be making.